All right. So let's resume from where we left off the other day. Where we were is here. Now we are looking at the session notes file. So if any time you get, you're not able to see what I think I'm showing you, you have to let me know. Okay, so we are continuing our discussion of, so where we are basically is, if you look at this file here, I think, yeah, project notes. We are using this project to try and learn about all these decision problems. So this is what we call action learning, where you're given a particular problem, and as you try to solve that problem, you find that there are several other decisions that you need to take, and we are trying to, in that context, we are trying to teach you how to take these decisions. So we've gone through all this. Now we are focusing on this. So when you read most finance textbooks, you will find that most of the discussion is actually centered around this particular DP. That is whether my bias should be to buy or to sell. They may not mention it explicitly like that, but that's basically what it is. So that entire, there are a couple of people in the waiting room. All right. So the entire discussion about valuation and all that, if you remember that we showed you the other class, we showed you this DP4 decision problem, solving this problem. What are the two broad approaches? So all the things that you do in your first year related to valuation, these are all connected to this particular decision problem. Why do you even do a valuation? Because you're concerned about comparing, your focus is on comparing value to price, the market price versus your estimate of fair value. And that's why you do all these valuation concerns. So you see most of the stuff is in finance, most of the discussion in finance textbooks, a lot of it is focused on this problem. Okay, so continuing our discussion of that problem, just trying to set some context here so we know where we are resuming from. All right, so we had this discussion. So this, I put a link here. You go straight to, now we are going into this same document, okay, DP4 solutions. All right. So we had all these discussions, FA, what I told you what you have to do in FA. I'll just give you a little bit more on how to apply for a fundamental analysis, because all of this here, all of this stuff here, essentially what we have called forecast-based valuation. Okay, all of it is basically all fundamental analysis, what we roughly call fundamental analysis. And usually when we talk about fundamental FA, I'm just going to say FA from now on, we usually are talking about, we don't really refer to this project analysis as FA, but essentially that's also what it is, okay? It is also the same, and as you would remember from your NPV formula, I told you about the fair value calculation, the general asset valuation formula. So the NPV is also in that same kind of framework, except the only difference is to calculate the NPV, you subtract the cost of the project from the fair value estimate. Right? So it's not, it is substantially, it's still the same thing. So FA, when we do FA, we are usually talking about these kinds of analysis of stocks and bonds, currencies, any other kind of asset, but normally not about projects, but we still refer to this whole thing as FA. Right, so under how do we apply FA? Let's go back to this. So we'll just talk about briefly, I gave you some idea about FA, that in FA you are doing all kinds of macro, micro analysis, political analysis, etc. Now, as far as you're applying FA to equity investing is concerned, which is what you're doing right now. So we will use this term called equity investing styles, okay, or investment styles, okay, or sometimes we call it investing styles, okay. So actually, let me just write, I think investing style is more commonly used. So we'll call it investing style. So that, again, a term, okay, so you have to be, this is like jargon. So usually when we say this, what we mean is, these are three broad areas. There may be some other minor ones, but these are the main ones that we have to worry about. Okay, value, growth, and income. So let's discuss each of these in turn, and let's look at value. Okay, so value is very famous for what some of you might have read. value investing. Okay, so value, when we talk about value, these are approaches to equity investing. All right, so these are approaches, different styles of equity investing. So if we talk about value, we use the term value investing. Okay. Sometimes you'll see this, these investing styles, you'll see them coming out in the names of equity funds. When you look at some equity mutual funds, you might find it named as Fidelity Large Cap Value, which means these are investing in large caps. So Fidelity is the fund manager, and the focus is on large caps. And so cap here is market capitalization, and value. So it's value, it's not growth or income. Why value? Which means they're going to apply this value investing kind of style to the population of large cap stocks. Okay, so what's value investing? Let's try to understand. Basically, value investing essentially is, let's look at what the idea in value investing is. Let me give you the basic algorithm. Okay, what is the basic algorithm? What we do is calculate fair value. In value investing, we calculate fair value, first step. Then I'm going to put everything in this kind of thing. So these are the next steps so that we don't have to go through too many lines. So first is, so value investing basically falls, as we said, these are all falling under applying FA. Okay, and as you know, FA is on this side. Okay, it's not on this side, it's not on the TA side. So it's on FA. So under applying FA, which means that everything I talk to you about here under applying FA is going to have the same characteristic, which is it will be based on this kind of a framework, that you will do a fair value calculation and then you will compare it to the market price and then you will take your decision accordingly. That we have already explained how this paradigm works. Okay, so you calculate fair value. All right, you calculate fair value compared to market price. We are just repeating it actually. So I think we already have it. Okay. Now, if we look at value investing, calculate fair value, compare to market price. Yeah. Okay. Now, usually we apply it. Okay. Now, yeah, this is how it's done. Okay. And value investing is typically applied as a long only strategy. Usual application of the reason I'm discussing value investing is partly because this is a very common style of investing. Everybody talks about value investing, and even your Warren Buffett, the books I've given you to read, Benjamin Graham, I'll show you the book just now. Those books, these are all basically, these are all value investing, all right? So, so usually you will apply this only as a, so just clarify, value investing is usually applied. And the reason for that is that if you remember your asset classes, major asset classes, 4 major ones, or even if you take the 5th one, real estate. So usually value investing is applied to stocks and bonds, and most of the funds in stocks and bonds, essentially stocks and debt, equities and debt, they are usually long only funds, generally. Okay, some hedge funds are long short, but they are usually long only, the traditional funds. And this value investing is an old strategy, investing strategy. So it's usually a long only strategy, and then it is only applied usually, let's say, normally used to describe equity investing strategies. Okay, so you will normally not see the term value investing being applied to describe investing strategies other than in equities, all right? But there is no reason for that. This is a common usage, but there is no reason why it can't be applied to any other asset class as long as you're following this basic. This is basically what value investing means. Value investing means essentially the first part of this strategy, that you calculate the fair value, compare it to the market price, and if the fair value is, and usually it's not just higher, but it's just you want it to be much higher, all right? So that you do this, and then You compare it to the market price, and then if it is much higher than the market price, then you buy. Usually you will not be selling, so it's applied as a long only strategy. And it is normally applied to used to describe equity investing strategies. But theoretically can be correctly applied to any asset class. So even if I do a valuation of the dollar against the euro and I find that the euro is trading at 1.1 and and I think the fair value of the euro is actually maybe 1.7, then I can still buy the euro and I can still technically still call it value investing essentially, but although the term is not normally used. So you need to know the context as well and how these terms are used in the industry. Okay. Now, another very famous investor who is, you need to understand at least the application to debt, which is important. Okay. Let's put it this way. There's a guy called Howard Marks. You should look him up on YouTube. He does a lot of interviews. Okay. So he runs a firm called Oak Tree Capital. All right. So here we are talking about, sorry, I got this. Oak Tree Capital. Now, this is actually, these guys are actually, what they're doing is they're applying the same value investing style that Warren Buffett is applying to equities. And these guys are actually applying the same value investing style to debt. Usually they're applying it to corporate debt. Okay. Value investing in debt. So his strategy is the same. So when I say value investing in debt, so obviously what these guys do is they look at corporate bonds. They see what the price of the bond is. Obviously in the bond markets, you talk about yield, not price. And they again do the same calculation. They find out what is the fair value of the bond. So they basically go here. Remember the same asset valuation formula. They will project the cash flows or returns from the bonds, and they will find out what is the return expected, and they will apply an appropriate discount rate. They will calculate a fair value the same way that you do for projects or stocks. And then if they find that the fair value is much higher than the market price, they will buy. Okay, so essentially what Howard Marks is doing, you should look him up on YouTube. You can learn a lot. Oak Tree Capital is the name of the firm. These guys are specialists debt investors. Okay, we call it, they basically would refer to it as credit investing, okay, because they're exploiting the credit risk and the pricing of credit risk. So they are also called sometimes distressed debt investors. Okay, so in the sense, this is another way of describing his investing style. So when we are discussing value investing, although the term is mostly applied to describe only equities, I believe at the very least you should also understand that the exact same style can be used even in debt investing. And one very famous example of this style is Oak Tree Capital, who are basically distressed debt investors, right? What they do in distressed debt is that they would take a firm like, let's say, ILFS, which has gone into all kinds of financial problems. They had to restructure debt and etc. So essentially a default, they defaulted. So they look at the debt securities of companies which like ILFS, which have experienced problems and not been able to pay their debts on time. So these guys, then they start looking. And so what happens, obviously, when you have situations like that, the market goes into a panic and they start selling the bonds of these companies in a panic. And then sometimes the bonds maybe fall too far in price, which is not really warranted by the actual amount of problems that the company has. So that's a person like Howard Marks. What he's actually doing is he's looking at these bond prices, doing his fair value estimates, and trying to find out if in some cases the market price has fallen too far below the fair value. And if that happens, then he will jump in and buy. And then later on, as the market price moves towards the fair value, he will make money. All right. So this is basically the idea. So you should be aware of this. Another very famous, sorry, let me just get some water. Another very famous aspect of Howard Marks is this guy writes some memos which are available to the public. Okay, so I want you to just, I'll put the link in here straight away. I'll just do a search on my other screen and put it here straight away. So this is again part of your education. As I said, look up Howard Marks on YouTube. I was just listening to one of his interviews the other day on the Federal Reserve actions. Okay, Howard Marks memos. Just doing a search, you'll find it straight away. All right, so I'm going to put this in here. So what he does is he writes these memos to investors. All right, so yeah, so you can look it up later on. I think for you guys, there'll be a lot of learning. Okay, even at my age, with my experience, I still sometimes find new things here. So you should read these things on a regular basis, and that will contribute to your education. All right, so you see how cool this doc software is. I can replace the URL like that. Okay, so please read this on an ongoing basis. You will learn a lot about markets. As I said, your education as a finance student has to be from an international perspective, not an Indian perspective, because Indian financial markets are not developed. So if you study from the Indian perspective, you will not learn, you will not get a proper education in finance. So very much, you need to have a very strong focus on international markets. All right, so we had a little bit of a discussion on value investing. How do you apply value investing in your particular project? If you want to do FA, although your time period is very limited, but what we are doing here now is, now we are trying to also teach you some of the theory in the proper way, not necessarily exactly what you can apply or what is feasible to apply in the short period of your project, because we are using the project almost as an excuse to teach you these things. Obviously, the project has a tremendous amount of value if you do it seriously. But when we discuss this now, we will be discussing in a fair bit of detail. So I may not be able to cover all the investing styles and both FA and TA before your project is over. But you already know that we've already discussed why these problems happen, because you don't have the luxury of having the ideal sequence. First, I teach you all the theory and then I make you do the project. We don't have that luxury, so we are operating within a constraint. So if you feel a little frustrated that, I don't know all the theory, why am I doing this project? This is just because of the constraints that we face. So adjust yourself to that and try to pick up whatever learning you can. All right. So we are going to just give you some idea as to how you can apply value investing, okay, in this. So what you would do is, now in this case, as you see, this screener that you have here, there are lots of, if we go back to the, if you see, these are the screen, these are the, these things are legible to you guys, this earnings date and all that. Can you read all that stuff? Let's ask, who should we ask? Let's ask.
Yes, sir. Yes, sir.
Okay, okay. All right, so you can read the stuff, right? So now this screen is what you see is what I did, okay, for you guys to select the stocks for your project, to give you a tight universe of stocks. So I have applied certain filters. Okay, a stock screener is basically nothing but a bunch of filters being applied to a database. All right. So I applied certain filters because I wanted to make sure there are some large cap stocks, then there's some volume cutoffs, etc. Now, what you can do if you want to apply, this is a reasonably good free stock screener, and you can learn the principles from here. By the way, you also have stock screeners in Capital Line, etc. Indian stocks. All right. So now let's look at how you would apply value investing, because in value investing, essentially, you're trying to look at, I will put this later on into a separate note on value investing. In the class, I'm writing it here. I'll put a hyperlink to that, and then it will be in a separate note. So there's no cluttering. Okay. So what you're trying to do is essentially you're trying to see the fair value, and you're trying to compare it to the market price. So what you would do is essentially the basic idea here is to look at prices which are very highly discounted, very heavily discounted to some normal measures of fair value. So you would apply here. Okay, so if you take the universe of stocks we have given you, okay, and then what you would do is you would apply in the context of your project. You see that I've organized it by sector. So what I did in your case is the way I selected these, if you go back to your tickers, the project tickers, how did I come up with these 33 stocks? I applied, we already had this discussion, but we're just repeating it. I applied these basic filters, which I like to apply for all funds, okay, which is that the focus here is on being in liquid stocks. So I made sure there was a large cap cutoff. I made sure there was a volume cutoff, couple of volume cutoffs, average volume and current volume. Then I made sure that it was US stocks, optionable, shortable, etc. And I also applied a price cutoff, so you could buy a sufficient number of shares. Now, having done that, now this is typically because I have applied these liquidity cutoffs. And then what I did was I went through each of the sectors and I picked 3 stocks from each sector, right? And that's how I ended up with this set of 33 stocks. And I forced you to stay within this. I forced you to stay within this universe. So what you can do now is, and this gives you a template for what you would do as a value investor in general, okay? In general, if you decided that or let me show you how to do it in general, that's easier to understand, and then you can apply it only to these stocks, all right? So what you can do is you're looking at valuation criteria. So if you see here, there's a tab called valuation, all right? You can see the valuation tab here. If you click that, now these are the same stocks. Now let's click on valuation, all right? You have the same stocks here. Just increasing it a little bit. You can see these are valuation criteria. So as a value investor, what you typically look for is stocks which have low price to earnings. Okay, PE is price to earnings. Maybe if I apply, will I keep the same screen if I apply it here? Yeah, all right. So here you can see the fundamental criteria. You can also learn the definitions from here. Okay, generally not too bad. The definitions are okay. So you can apply. So normally what we do as a value investor is we apply various types of fundamental cutoffs which relate to valuation versus the market price. So what is price to earnings? Okay, that is price per share divided by earnings per share. So when you look at your FCX has nothing because they made a loss in the last period. Okay, so let's say we had, if we had looked at, this is I think what, Nucor or somebody, I think. All right, anyway, it doesn't matter. So if you looked at this, the price to earning 27.86, that means price divided by earnings per share is this figure. Okay.
Sir, can I say something?
Yes, yes.
Sachin, this side, sir. On my analysis, what I understand that if the price PE ratio is less, we need to invest. We need to buy this share, buy that share. If PE is less.
Yeah. So if we are talking about value investing, yes, you are correct that buy low PE. Okay, let's put it in general terms. Okay, indices of value, indices of market price being much lower than fair value. Okay, so let's talk in general terms. What are the indices? Since we are discussing value investing, right? So basically, we are trying to figure out whether or not the market price is much lower than fair value. That's what we're trying to do, right? And so what Sachin has told us, one is obviously that low PE. That's what he's saying, okay? So what you have to remember, Sachin, is your answer is correct. And obviously, you have given it in the context of our discussion on value investing. But as a general principle, please understand that Sachin's answer is only correct if you are a value investor. Okay, if you are not a value investor, you know there are other styles like growth. Okay, if you're a growth investor, Sachin's answer is not necessarily correct. But in the context of this particular discussion, yes, low PE is one. Okay, then low PB. Okay, which is price to book. I'm just giving you some examples. And then you will do readings. You know, I've given you some important readings like this Benjamin Graham book, Analysis of Financial Statement. Then you have a book called The Intelligent Investor. These books, which I've already given you to read, these are very important classics of investing. So a lot of equity investing is focused on value investing. And I've also given you the link to a 2-hour interview of Buffett. So, and there are lots of interviews of Buffett's on YouTube. So I would recommend that if you want to learn more and more about investing, listen to lots of Buffett interviews. Then there's his investment partner as well, Charlie Munger. And listen to lots of Howard Marks interviews. Okay, there's a different perspective on debt investing, but you need to know everything. So if you listen to these interviews, you'll learn more. Okay, so these are some common indices that we use: low price to book, low price to earnings. Let's look at some other indicators. Okay, you could also use price to sales. Okay, there are various indicators. Now this would be a very good indicator, price to cash. If you find a very low figure of a price to cash, which means this is like cash on the books per share in the denominator. So this is like a no-brainer because, you know, here you can see that obviously the cash is directly available. There's nothing uncertain about the cash unless there's some accounting fraud. So, which actually happened in cases of companies like Satyam and all that, where they actually, you know, committed fraud even on the cash figure because the auditors did not check the FD receipts. All right. So price to cash, price to free cash flow, these are all important benchmarks. So what you would do if you were a value investor is you would find companies which have good returns otherwise, all right? Good return on equity, good return, good gross margins. You can do all these calculations. And then what you would do is, I'm not going to actually do it here. You would then apply these filters here. Okay, or you would just see in this case, if you want to work with the initial filter of 33 stocks I've given you, you look at FCX and you look at their metrics. Is the price to, what is the price to sales figure? Is it low? Okay, is the price to book, is it low? And then price, all these indicators, if these are low, that means they offer good value, right? This is what you have to look out for. Another very important thing which Buffett looks as, I don't like to look at this earnings per share generally. I prefer to look at low. Actually, I should just put low outside the bracket and put, instead of writing low all the time. There is price to BVPS. Okay, BVPS is, what is BVPS? Anybody? BVPS is, this is
Book value per share.
what? B is for book value.
Book value per share.
Yeah, book value per share. Okay. So book value means your net worth. Net worth divided by book value per share. So this is basically the book value of equity. This book value is referring to book value of equity. So book value of equity divided by book value per share. I prefer to look at this actually, and so does Buffett, because this actually, remember, EPS can be manipulated by doing stock splits and all kinds of stuff, you know, stock buybacks, and you can manipulate the number of shares. So I am never a fan, although the market focuses constantly on earnings. I prefer to look at you know, return on equity rather than earnings. Return on equity cannot be fudged. Earnings cannot be can be fudged. Earnings per share. Let me just write it as a general principle here. Okay, ROE is better to focus. This you will not find discussed in every place. Mostly people just go with the earnings per share, but it's always better to focus on ROE than EPS. Okay, although all market discussion is on EPS, because this figure can be manipulated. You cannot manipulate this figure unless, of course, you're doing accounting fraud, which is a bigger investigation. So, but if you take the accounting figures as, if you accept them on at face value, then this is a much better indicator. So what Buffett looks at, and the same concept is coming in here basically. So Buffett prefers to look at the trend of, and these are also, generally you look at the trends. Okay, so Buffett looks at the trend of, if you see lots of Buffett interviews, you'll pick up this information that price to book value per share, that is an important indicator. So essentially this is the same. Okay, so it's price to book and price to book value per share, but we sometimes just we call it okay. So price to book or price to BVPS. These are the indicators. You can also look at price to sales. Right? These are all indicators. Sometimes you look at the enterprise value divided by the EBITDA. Although again, I'm not a fan of this. Buffett is also not a fan of this. Sorry, this is EBITDA. Okay. These are some other value indicators. Okay. Even Buffett does not like this figure because it can be manipulated in many ways. All right. So you can play around with it. So these are all different indicators that you use. So the basic idea behind value investing is you would apply these figures. Like you would look at this filter and say, okay, show me all the companies where the price to cash is under 1. Right? You can set up this filter. I'm not going to do it now, but you can do it this way. Show me all the companies where the PE is under 5. You can do this kind of calculation. All right. And this is typically how you apply. Then you hit filter, and this will get filtered, and this will only show you the stocks which meet your criteria. So this is how a value investor operates. Then they start, first they do a screening. They find out which stocks are scoring well on this kind of a metric, and then they do some further analysis, and then they decide to buy. Okay? This is basically what value investing is. Growth investing,
Sir,
yeah, yes.
sir, for ROE, we basically in that site we basically focus on the price cash thing, or ROE, return on invest.
ROE is return on equity. Okay, so return on equity, you will find a filter. I think here itself there should be a filter here. See?
Okay.
Okay. So ROE is return on equity.
So we just select the one that is highest, or a combination within, or
Yeah.
ROE is the top.
Generally what you're looking to do when you're picking up value investing is you're trying to when you're doing value investing is you're trying to, you would never buy stuff where there is low ROE. Okay, generally you would always like something like ROE, always higher is always better. Okay, so ROE higher is always better, obviously. So what you're trying to do in value investing is picking up stocks which for some reason there's some panic. Like maybe here you look at GE, which is a good company, or you look at, there's a discussion, I was looking at this discussion the other day about Exxon Mobil because of the fall in the oil price. So if you look at long-term data on Exxon Mobil, now people see that, okay, this is such a major oil company, okay, huge company. So some people are saying now this company at this kind of price, look at how far it has fallen from the peak. And this is like a gigantic oil company. Now people are saying that this is a fair value. This is actually a value investing pick because they are saying that oil demand is not going to fall that much. And so eventually it will rise. And so the fair value, what they're saying is actually the fair value of Exxon is much higher. They didn't discuss a particular number, but let's say they say that the fair value of Exxon is $90. Now you're getting the stock much lower, okay? At around what, $39, $40 or something like that, 35, 40. We don't know exactly what the figure is, around $40, let's say. So if you think the fair value is $90 and the market price is at $40, okay? And then you would obviously be a buyer of the stock. And coming back to Shaurya's question, yeah. So one of the things when you look at in terms of your, when you do your value investing screen is, you want stocks which have generally got a good return on equity, but for some reason they have sold off, okay, while the market has sold them up. So equity generally you want higher, ROE generally you want higher in the screen, okay. So that is that. Does that answer your question, Shaurya?
Yes, sir.
Okay. So that's the basic idea. Okay, you try to see these are all basic metrics of good value. Okay, that means value is much higher than market price. And so this is what you would do as a value investor, right? You would do this. This I was just showing you how I came to these selections. I can cut this off now actually. This screen. Okay. So let's come back to this. So in terms of now moving to growth. Okay. So one investing style I've given you, which is I'll maybe have a note on investing styles, which I will hyperlink here, and all this text will go into that. Okay. Then if you talk about growth, that is almost opposite to value. Because in growth, you don't really worry about these kinds of, there has to be a low PE and, low price to book and all that. We don't really worry about all that. In growth, if we're talking about growth, let's say growth investing. If we talk about growth investing, what we are really interested in is typically we are looking at high sales, high growth of sales. Sometimes we also look at users in the case of some of these, because a lot of the growth companies are actually tech companies. You'll see that very often the tech companies like Facebook, Twitter, Snapchat, etc. They are valued based on, the market tries to establish their fair value by looking at how the user base is growing. Okay, so this is another thing that they use, because sometimes you don't get a very good understanding of the sales, because the sales is driven in these platforms. It is driven by, first you have the users, and then you start selling advertising, and then sometimes you don't get the ad revenue figures so clearly. So you look at users as a proxy. Okay, so sales, usually we worry about sales, high growth of sales, profits, and you can also look at profits. So you can look at, I'll just write profit. Okay, but sometimes, a lot of the times, in the case of growth stocks, you look at sales. This is the most important thing. Okay, top line sales growth. This is what they look at, because we're saying that this is growth companies. And so the classic example of a growth company would be Tesla Motors here. Okay, we're not making a lot of money right now. I think they're not even making, so it's a stratospheric rise. Now they had a stock split. I think these guys have not adjusted the share after the stock split. But anyway, so all these are the examples of growth companies. If you do these calculations, they all had stock splits actually. Even Apple had a stock split, if I'm not mistaken. Let's look at Amazon. Yeah. They might have also had, I'm not sure actually. I didn't hear about Amazon. Let's look at this. Yeah, Amazon, I think she should be okay. So these are all companies, if you look at, these have been rising in a stratospheric way, their share prices. Okay, so these are all examples of growth companies. So if you look at, if you're looking for growth companies, what you would do is you would apply, or in this case, if you look at our universe, and if you look at applying this logic, you can do it either way, but more relevant for your project is to do it within our universe of stocks, because you're not allowed to buy Apple or Tesla in this project. So you would look at FCX and you would look at the growth indicators, like what is the EPS growth? Actually, as I said, the screeners will only offer you EPS growth, but actually what you should really look at is the trend of ROE. You should really be looking at what is the trend of ROE, what is the trend of return on assets, other kinds of metrics, looking at their trends. EPS, I'm not a fan of EPS, but because everybody talks about EPS, these things are actually oriented towards EPS. But you look at sales growth in the past 5 years as an example of a growth stock, a growth metric. Okay, so you would look at, is this company showing high sales growth? So what you would do is, if you were applying it on a blank slate, you would look at here. See, EPS growth this year. You want, let's say, a high EPS, so you would put it as over 30%. or over 20%, let's say, something like that. Okay, so you would go and apply a filter here. EPS growth quarter over quarter, this also you would apply. Okay, then sales growth, yeah, sales growth, this is the most important actually for growth stocks, sales growth quarter on quarter. Then EPS growth past 5 years. These are the kind of metrics you would use. Mainly you would look at sales growth. Okay, and then you would do a fundamental analysis of that company, their business model, why you think, like the Tesla stock performance is all driven by the market believes that electric cars are really going to take off. And Tesla has a dominant position in electric cars. Okay, although electric cars have not really taken off that much, but the market believes that it will. So that's why the stock is going up. So there's a focus on sales and there's a focus on future sales. So if you go back to our valuation model, what I think we can shut this. You don't need this right here. If you go back to our model, what the market is doing is, this is applying a fair value model like this. And they are going to, if you look at our, go look at this, which we did the other day. What the market essentially is doing in the case of Tesla is, it is making projections, the same kind of fair value model that we discussed in the last class. These forward projections of, eventually you will be discounting earnings, but earnings come eventually from sales. So the first top line projection of sales, what they're doing for Tesla is these future projections of Tesla. The market has very, very high numbers for this sales figures in the future, because they think the electric vehicle growth adoption will be very high. So that's where the fair value of Tesla becomes very, very high, because these forecast numbers are very high by the market. If you think that the market is trying to actually look at to approach the fair value. Okay, or other investors who are buying Tesla, they have very high estimates because the sales figures here are very high. And then you discount from there, you come to the earnings, and you discount the earnings. The earnings are also very high. So that's what is happening. So you can connect the market action. The same thing is happening with Amazon also. But you can connect the market action to what you have studied in the past as your equity valuation models. Okay, it's the same Gordon growth model where they're predicting higher earnings or higher dividends in the DGM case. And where are those dividends coming from? They're coming from higher projections of sales. So you connect all that. So that's what growth investing is. Okay, you basically focus on price companies which need not have high profits right now. Okay, high growth of sales. The important thing to understand is that although I've written profits here, okay, some companies have profits and some don't. Okay, like Amazon can actually show a lot of profit, but they do so much investing for the future, for future growth, that they don't have very high profits. So all he has to do is basically stop investing so much in the future, and then he can show a lot of high profits. So you can look at free cash flow also. It's another metric that people use. Okay, growth of free cash flow. Then the important thing in growth investing is that not necessary for company to be profitable currently. Okay, this is Tesla is just struggling around the profitability mark. Many companies are not currently profitable, but they have high valuations because they are growth stocks. So this is an important distinction between growth investing and value investing. In value investing, generally you will, almost universally, you will never buy stocks which are not making money right now. What you're looking for is highly profitable, like Exxon is a classic example. ExxonMobil, okay, very, very profitable company, high dividend company. And this company will obviously continue to maintain this discussion on Exxon that I was referring to, where, in fact, I'll try to find that YouTube thing and try to put that here later on. Maybe I'll do it later. I won't waste the time now in the class because there's a very interesting discussion on oil prices and things like that. Okay, so the point is a very important distinction between growth investing and value investing, which is that in growth investing, you may buy stocks which are not necessarily profitable right now. Okay, but in value investing, you'll almost never do that because you're looking for already highly profitable companies which are stable, mature companies. But for some reason, the market has panicked and sold off the stock, and you get a situation like Exxon where the price is very low, and you think the price is much lower than fair value, and this is a highly profitable company. A highly profitable company, so that you feel very safe about uh, investing in this company. So therefore, this is a very important distinction to understand between growth investing and value investing. All right, so we have done these three, and income investing, this is also something that you should understand. So sometimes you might hear a term like, let's say, Legg Mason, which is an asset manager. So Legg Mason, I think they were bought by another company. I'm trying to remember which company it is. But somebody bought Legg Mason. Let's say income, okay? So income investing. Okay? Normally don't use this kind of language together in income investing, but I'm just trying to make it similar to growth investing, value investing, income investing. Essentially, this is about buying, and all of these are long only styles, because these are from traditional asset management. We will come to the distinction between traditional and asset management and alternative asset management. We'll have that discussion later, but these are all traditional asset management styles. So that's why I'm saying buying, because these are all long only styles. So buying, shall we say, good, let's call them blue chip stocks. So blue chip stocks are actually means reasonably well-known stable companies. Okay, blue chip stocks, probably price sold off, market sold off too much. Okay, just like your ExxonMobil. ExxonMobil would be both a value investing play as well as an income play. So income investing, this is the style, the term that we're using, essentially buying blue chip stocks. And the main thing here is the high dividend. Okay. This is basically the main this is the main feature of income investing, okay, because it is income. This is the term that we are talking about. Just like here, we are talking about growth. So I'm just giving you a rundown on three major equity investing styles. And value investing, as I told you, can also be applied to debt. Although you can't have growth investing in debt, okay? Because debt returns are fixed. Growth investing, value investing can be applied in debt also, like Howard Marks does. But remember that growth investing cannot be applied to debt, because in debt there is no growth of income. Okay, you are promised a certain return on the bond, and that's all you get. Even if the company does very well, you don't get more. So there is no growth investing in debt. But value investing you can have in both debt and equity. And income also you can have in bond markets as well. But generally, again, we apply these for equity investing. And
Sir,
yes.
Sir, so in short, we can say value investing is basically looking at return on equity, and growth investing focuses on growth in sales and growth rate in general, and income investing is basically related to dividends.
Yeah, I think the second and third statements I agree, but the first one is not just looking at return on equity, but the main thing in value investing is, because the other two you described correctly, okay. Growth investing is basically all this return. You look at the growth of sales, okay, sales or users. But value investing mainly is to find out the fair value. That it's not just return on equity, but all other indices of returns also, return on assets, return on operating margin. Okay, you find out all the indices of profitability. Essentially, the idea of value investing is let's say, find profitable companies. So return on equity is one indices, let me write, instead of writing profitable assets, let me write assets because it is more general than companies. Okay, so you can apply it in debt also. So the first thing is to find profitable assets. Okay, which means high gross margin. So you can look at many indices. You can look at high, say, gross margin. Then you can look at ROE. You can look at ROA. Okay. These are typically the things that you would look at. You don't want to look at too many things because then you get confused. Okay, so usually we look at gross margin, we look at ROA, and normally ROA is calculated as, if you see here also, in ROA, I'm sure there's an ROA somewhere here. Okay, so usually they do, they look at the earnings by the total assets, but that I think that's the traditional definition of ROA. Actually, what I think you should look at is, because the earnings are only for equity holders, that they have already deducted the interest payment for debt. So this is not a proper ratio, although it's a well-known ratio of many years, been used for many years. I prefer to look at basically ROE is a correct estimate because your numerator is earnings and your denominator is equity. It should be average equity. Okay? Earnings for this year divided by average equity for average equity for this year, which means beginning of year plus end of year equity divided by 2, average equity. This is a correct figure because earnings belong to equity holders and you are dividing the denominator is also the equity. This is actually used as, this is calculated as earnings which belong to equity holders and then total assets. So if a company has no debt, these two will be the same. Okay? But since most companies have some debt, these will not be the same. Now, I'm not a fan of the traditional measure of ROA, which you find here, which is this. Okay, as you can see, earnings divided by total asset. This is, I think, that the right way to calculate, this ratio is to be like for like. You should actually look at, or better, what I'm trying to write here is operating profit divided by total assets, because the total assets have been financed by both debt and equity. So when you divide operating profit by total assets, you really see the actual profitability of the asset base. Okay, because you're at operating profit level, you have not deducted the interest payment. Okay, so this I feel is a much better measure than the traditional calculation of ROA, which is net income, which is earnings divided by total assets. Actually, because total assets can be funded by debt, by equity and debt. So you should look at the numerator should be some figure, which is the amount of money available to pay both. And in fact, you should take out the taxes also in this calculation. You can adjust that, but let's assume that we don't do that adjustment. You can keep it same for all companies. But essentially, you have to see what is available for distribution to both debt holders and equity holders, and then divide that by the total assets, because that is the true income generation from the total assets. Because here you're deducting the interest payment, which is not, you're understating this. So you do these kind of calculations. Now, what is the goal of doing all these calculations? Let me put this bracket here. All right. What is the goal of doing all this calculation? All these calculations are basically, these are all ROE, this kind of operating profit, gross margin. These are all intended to find out how profitable this company is. Okay. So the main thing in value investing is you find profitable companies. Okay. Or you can go from the other side also. First find companies which have low price to book, low price to earnings. First find this user screen. First find these with low price to earnings, low price to book, low price to sales, low EV to EBITDA. First find these. Then ask yourself, are these companies highly profitable, because in value investing you need both. You need one, that the market price should be much lower than fair value. If we do this calculation, let's say if we take an example like ExxonMobil, if we do this as an example, we can check what is Exxon, because we can clearly see that in the case of ExxonMobil, there's a very sharp sell-off. All right. So let's see whether Exxon. So what I do is I see here. Now, if you look at ExxonMobil, here is the price. Even now, the price to earnings is still quite high. Okay, even the forward price to earnings is quite high. But if you look at some of the financial criteria for, yeah, now you look at, now these are actually the ROE figures are not very good. If you see, I don't know if you can see the bottom of the screen, but the ROE figures for ExxonMobil right now, you have to look at the trend of ROE also. These are not very good, okay, because this 3.9 is too low as a ROE figure. Needs to be at least double digits, usually preferably better than 15%. So, but this is a low ROE figure. So what happens is this fails the second test, kind of. You find that yes, okay, it is a very beaten down stock. Maybe you do a price test, then you find out, are these also profitable companies? So sometimes you may find that there are profitable companies whose stocks have sold off too much. So it's a very low PE stock, low price to book, but the profit company is highly profitable, high gross margins. And that's when you go in and buy as a value investor. Okay. This is clear, Shaurya?
So basically buying a stock at a low value of company which is highly profitable.
Correct, correct. It's a bargain. Basically, think of it as a bargain. That you have a high quality asset where you wait. Waiting is also an important part of it. If you read the books I've told you to read by Benjamin Graham and Philip Fisher, all these things,
Sir, the connection was cut. I missed some part of it. It just got cut for a minute.
Okay. So the point is this, that you wait for a while, you wait for a market to sell off, and then you find a company which is a highly profitable asset, but because of market panic, the market has sold off the asset too much and the price is much, much lower than the fair value estimate that you have. And then you pounce and you buy. That's value investing, basically. Okay. So we have an idea now about value, growth value, and dividend. Okay, I'll just spend a little bit of time on dividend. Now, if you see here, that discussion I was listening to on ExxonMobil, one of the things they focused in on, look at the dividend yield here. Okay, this is the dividend yield. Now, if you see here on fundamental criteria, there must be a filter on dividend yield. Can't find it here. But usually you can do this in most of the stock screeners. You will find a filter on dividend yield. Maybe it is in the descriptive box. Yeah, see, dividend yield. So dividend is basically, dividend yield is dividend per share. You can see the definition here itself. Annual dividend per share divided by the stock price, right? So dividend yield. So then what you think is, as market sold off, so high dividend, sometimes we say dividend yield. So this discussion. So when you hear dividend yield, in this context of income stocks, income investing, there are two terms you need to learn. Okay, high dividend yield or earnings yield. Okay, these are the two terms we use. A high dividend yield or earnings yield. Normally we focus on dividend yield. Okay, so dividend yield is obviously, as you can see here. Yeah, so these two high dividend yield or earnings yield. Okay, this is how I've written it. So these are the two important terms you need to know when it comes to income investing. So somebody will look at you, will point to ExxonMobil and say, hey, look at this, guys. This is an income fund, and for our income fund, we can buy ExxonMobil because it's a very high quality company with great assets. And look at the dividend yield, almost 9% dividend yield, which means you divide the dividend by the market price, okay, and then you get this kind of a return. So it's a very high return. Okay? Later on, you'll see one of the elements of value investing also is a high dividend yield. Okay, but there is more to value investing than just that. Whereas when it comes to income investing, we just look at the dividend yields and then ensure that or you can't ensure anything, but let's say verify that dividend can be maintained in the near future. Okay, because obviously if they cut the dividend sharply, then this will not apply. All right, like General Electric recently had cut the dividend because they were experiencing a lot of problems, cash flow problems. So they
Utsav is waiting in the lobby. If you can.
Utsav and Gagan. Okay. Yeah, just remind me if somebody is waiting, just remind me. Okay. So we are discussing, so we are learning about some important investing styles in FA. Okay. Growth investing, value investing, and income investing. We need to have some idea about all of these. As I said, in your project, you may not be able to apply all this directly because the project time frame is so short. But now we are shifting towards getting some good theoretical foundation also in terms of our learning, which may not directly be applicable to the project right now because because the project has a very short time frame. Ideally, what we would do is we would be running. I would ideally teach you all the theory in the first year, and in the second year, I would make you do these projects over 1 year, and I would simultaneously run 3 projects. That would be the ideal way, but the program structure doesn't allow me to do. Actually, I wanted to do that, but the PGDM office did not allow me to do that because then obviously you can't release the project grades for 1 year. You can't release the course grades for 1 year. Imagine that, because your project is going on for 1 year. But that's actually the ideal way. This is the problem with a lot of education, traditional education, is that there's so much bureaucracy that you think about things like releasing project grades and releasing course grades. These are not really important. More important is where the real learning comes from. So in many cases, because of the academic bureaucracy, which you can't really blame our institute, maybe even AICT won't allow it. So you have to also think of it as students. A lot of times academic bureaucracy actually gets in the way of learning. If you really talk about learning, that's how I think I would do it ideally, that your projects will run for 1 year, second year. Whole year you'll be doing the project. And then your courses are done in the first year. But anyway, so those are just dreams, okay? I'm dreaming over here, but I'm just sharing my dreams with you so that you know why we are doing what we are doing, at least, okay? So 2 important terms in income investing: dividend yield, earnings yield. How is it done? You can go there and check, okay? Here, dividend yield, you can see what it is. So earnings per share, and a dividend per share divided by market price of share. Important thing in income, just like in value investing, not only do you want low PE, low price to book, but you also want a company with good profitability. Okay. In the same way, in income investing, not only do you want a high dividend yield or a high earnings yield, you also want to verify that this dividend can be maintained in the near future. So for this, you look at management announcements, like Exxon has recently announced that they will be maintaining the dividend despite the difficult market. So you need to look at management announcements, you look at their cash flow patterns, and make an estimate for yourself that the dividend can be maintained. So if you are okay with that, if you think it can be maintained, then you go in and buy. So Exxon would be a good addition to a income portfolio because the dividend yield is very high. You can look at any here. We can add one more thing here. Let's look at any dividend companies with dividend yield over 8%. We add this. What happened? I have to add yeah, within that, there's only one company with a dividend yield over 1%, I think, because this is already operating within these constraints. Okay. So anyway, so this is how you would do it. So essentially, this is what equity income investing is. Okay. So these are the three approaches, broad approaches that you can use to FA, to do practice FA as an equity investor. And obviously, you have to do your financial statement analysis. So you can play around with this. When you do, you can play around with a stock screener and start doing different screens, practicing. And also, as I said, go back to your first year materials on financial statement analysis and look at all these, make sure your ratio analysis is very, very strong because you will need it in DT Sir's course as well. So make sure you do all that. And this is how you practice doing FA, right? Now, here, one important thing that you should note, okay, that for this kind of approach, okay, so if I ask you about the key assumption of this kind of a situation, okay, let's ask Varun. So Varun, you understand this value versus price comparison framework that we are discussing, right? In this on
Yes,
the
sir.
right, yeah, okay. So we have discussed the short case study of ExxonMobil. So I do an estimate of fair value, and let's say my estimate of fair value is $90 for ExxonMobil, and the current price is around $40, and I decide to buy. Okay, if you remember the answer that Harsh gave a couple of days back, when we had a similar question, how we would, when we were trying to understand this framework. Now, my question to you, Varun, is what is the critical assumption when I'm actually behaving like this? I'm choosing to apply this framework, and what is the critical assumption of this framework? Because I apply this framework, I look at ExxonMobil, I estimate my fair value based on my forecast of of earnings per share, okay, total earnings actually, and the usually we do it for free cash flow and all that stuff. Whatever you do, you estimate a fair value, and then you find that it's $90, and then the market price is $40. So I said, okay, the market price is much lower than the fair value, so that I'm going to buy. So in this case, Warren, what is the critical assumption that I'm making?
Sir, it could be that we assume that the present price of the share is down because of sudden excess sold of such share in the market, and within short period of time it will recover its fair value. So it will be preferable to buy that share at that point of time.
Okay, so the second part of your answer is basically what I was looking for. Is that, is what he just revealed there, is that we are assuming here the critical assumption when you apply this kind of framework. So when you do value investing, etc., when you apply this kind of framework, the critical assumption is that the market price will eventually return to fair value. Okay, please make sure you understand this. Okay, because if that assumption is not true, then what you're doing doesn't make any sense. Because if there is no reason to believe that the market, so you understand that this is a very important assumption of this approach. Anytime you use any of these analyses, okay, any of this, your project NPV, buying bonds, what Howard Marks is doing, buying distressed debt, prices much below fair value, when you do value investing in equities, whenever you do all this, the basic assumption should never forget that you're assuming that the market will eventually return to fair value. And remember, fair value is not some objective thing. Like when did the sun rise in Delhi yesterday? That's an objective piece of information. Just go to the Met Office website and find out, and no one can argue about it. But this version of this fair value that I came up with, $90, this is subjective, okay? If we go to somebody else, if we go to Mitali, then she might say, no, I think the fair value is $50. Or maybe she will say, no, it's actually $30, okay? So there's nothing sacrosanct about this, my estimate of $90, okay? Which is, Mitali, you need to put yourself on mute, actually. So one of your IDs is not on mute. Okay, so the point to understand here is that, so the critical assumption, so you understand the vulnerability of this method, okay, that it requires this assumption to be true. And the assumption is that the market price is eventually going to return to your estimate of fair value. Just imagine your estimate. I mean, what is so sacrosanct about your estimate? Maybe your estimate is wrong. So this is very important to understand. Let me write it down. Very important, that because remember, value is always subjective. Value means fair value, which is always subjective. Okay, in these four, not always. When you go to AFV, it's not, but we are not discussing AFV right now. When you're applying any of these methods, value is always subjective. If you saw in Project NPV, Maruti set up their new plant in Sanand based on very high projections for car demand in India. And as we discovered later, the car demand projections did not quite pan out. And of course, now with COVID, it's a total disaster. So, so therefore, there's nothing sacrosanct about these projections which you make. All right. That's why I was telling you that yesterday, in the other session. Most important learning of these when you're discussing these theories. Remember that these things, these projections that you're making, these are just a bunch of assumptions. Okay, and nobody will tell you this except me. Remember that these are just a bunch of assumptions, so don't fall in love with these things and understand how fallible these things are. That they basically don't really mean anything, okay? They can just go for a toss. Something happens and they just go for a toss. So understand that. So very important. The key assumption is that eventually, and we wanted to do pretty soon actually, ideally pretty soon. Return to my estimate of fair value. Okay. All right. We'll return to my estimate of fair value. This is also important. I think let me just increase the font size here. Yeah. So this is a very key assumption that market price will return, okay, will eventually return to my estimate of fair value. This is always the right way to look at it, to understand that it is subjective, okay. So this is a very important assumption to understand, okay, and so don't lose sight of it. And of course, there is no reason in this context. Let me tell you something about a very famous quotation, which you should not forget, okay. There is in this context, but let's say put it this way. This assumption need not hold, okay. Okay, so in this context, you have to remember, because as you can see, if I have an estimate of $90, well, the ExxonMobil will already come to $40. Who knows? Maybe it will come to $20. Maybe it will come to $10. After all, at one point of time, it was at these levels. So how do we know that it's not going to come here? There's no guarantee of anything in the market, right? So there's an assumption that I'm making, and that assumption has no, guarantee of turning out to be true. So therefore, you have to understand. That's why I say you have to be very focused on risk management. So on the question of risk management, there's a famous quotation which you must never forget, okay, which is, have you guys heard of a guy called Keynes, John Maynard Keynes, the economist? Has anybody heard of Maynard Keynes? Let's ask Mithali, since she seems to be sleeping because she has not yet put herself on mute. Mithali, have you heard of Maynard?
Yes, sir.
Yes.
Sir, am I audible?
Yeah, okay, you're audible. Okay, so you're not sleeping. Good. Okay, have
No, sir.
you heard of John Maynard Keynes?
No, sir.
Okay, let me just give you the quote, which is very important. Never forget it. Okay. Everybody understands what solvency is? Solvency means being able to pay your debts as they come due. So when the stockbroker requests margin, you should be able to pay more margin money, because you're losing money on your positions. Okay. If you don't understand anything, you have to ask me. Okay. Now, this is a famous quote from John Maynard Keynes. Okay. Because actually he was an economist, and he was also, you might have heard of Keynesian policies. Okay. They are actually sometimes inappropriately applied to Keynes, but this is the source of that name. So Maynard Keynes is a famous economist and is also a famous money manager. He also managed funds for universities, and he did pretty well. So what he's saying is that the market can remain irrational for longer than you can remain solid, which means basically what he's saying is, suppose I buy a huge amount of shares. Okay, I don't follow my risk management guidelines. What I told you guys to do. I don't follow this kind of method where I go into this kind of calculation. What is my risk capital? Uh, and how many trades I'm going to do? What is my maximum risk per trade? And then I do my position sizing based on this calculation. I don't do all these things, and I buy a massive amount of stocks. Maybe I put 90% of my portfolio into this stock, and then I buy it here at $40, thinking that the fair value is $90. Okay. Now, what does he mean by market can remain irrational here? What does market can remain irrational means? Let me explain this quotation. It's a very important quotation to understand, get a full understanding of of FA. You need to understand this quotation. Market can remain irrational means that market price can remain below my estimate or your estimate. Okay. This is what it means. So when we use the word rationality or irrationality in the context of market prices, what is the time here? We still have a little bit of time. Okay. So when we use the word, this is an important word to understand also. Okay. So here in this famous quotation, which you should understand very well, important part of your learning, the key words are market, irrational, longer than, and solvency. Okay. So basically, let's say I have used a lot of debt also. Okay, in the US, you can buy stocks on debt by borrowing money from the broker. So if I buy, let's say, if I have $100 million in my equity, $100 million of equity in my account, and I put up 90 million, or let's say I put up 95 million of my account. Let's make it an extreme example. I put up 95 million of my account equity, and I borrow another 95 million from the broker. So I buy $190 million worth of ExxonMobil stock, okay, at $40, thinking that the fair value is here. Now, why did I buy this? Because I said, well, the market is irrational. What do I mean by the market is irrational? Because the market price is much lower than my estimate of fair value. So it's irrational because, according to me, rationality, if the market were rational, the market would be pricing the stock at my estimate of fair value. Okay, that is the meaning of rationality and irrationality. So the first thing you should understand, irrational means market price can remain below my estimate of your estimate of fair value. Is this clear to everybody? Make sure you understand these terms. They're very important terms, and the lesson of this quotation is very important. Okay. So now what happens? What is he saying? First is what is irrationality, and what is so you understand what irrationality is. For longer than, that is obviously you understand. Okay, that my class ran longer than 2 hours, much longer than 3 hours. So 2 hours was over, but my class was still running. Okay. So longer than is clear that market irrationality can persist for longer than you can remain solvent. Now let's understand solvency. Okay. Solvency means ability to pay pay your debts as they come due. Okay. Now, what did I do? I put up 95. I had $100 million worth of equity in my account. I put up 95 million worth of that equity, and I borrowed another 95 million. I bought $190 million worth of stock of ExxonMobil. Now, what happens? I buy it at $40. The market keeps dropping. As the market keeps dropping, the mark-to-market losses on my portfolio will keep on increasing. Is everyone clear about that? Okay, because when I bought it, and the market remains, I bought it at 40, market remains at 40, mark-to-market is 0. When the market goes, say 5% down, then my market portfolio, I have lost 5% on $190 million. Okay, in this manner, and so on and so forth, as the market keeps dropping. So if the market keeps dropping, there will be a time when when the losses on my $190 million worth of stock is greater than $5 million. Remember, I have only $5 million worth of equity, extra equity left in my account. Now the broker is going to ask you, you need to pay up. You need to make good your losses and put some more margin because you're losing too much money. Now, if I can't meet that demand, now when the broker says pay up, that means I have a debt. So I can't pay this money because at some point of time, what will happen is I don't have any more cash left. I don't have any equity. So at some point of time, I've lost so much money that I can't meet my margin call. And then the broker, what he'll do is he will sell the stock. He'll say, okay, I can't maintain your position. I'm going to sell your stock. And then I will still owe him for the losses on liquidation. So this is what Keynes is talking about. That be careful about this. Okay, I'll just take one extra minute to finish off this point. Very important point. Never forget this lesson. You may not hear it in a lot of places. Okay. That so what is Keynes saying? That this kind of approach, value investing, where you start looking at an irrational market because the market price is below the fair value. What he's saying is, well, don't get carried away by this, because if you think the market is irrational now, well, it can get a lot more irrational, and it can remain irrational. It can go to $20 and sit there for 9 months. What will you do? You have to pay interest on the borrowed money as well. So you can get really hammered because there is no guarantee that the market is going to come back to your estimate of fair value. So you can get killed. That's what he means. Okay. So very important lesson to learn in terms of value investing. Okay, when you're applying that. Okay. And then one more thing I will mention. Please make sure you understand this correctly. That value investing is a mean reversion approach. Okay. So please understand that value investing is a mean reversion connected to your earlier learning on momentum versus mean reversion. So please confirm to yourself that value investing is a mean reversion approach. Okay, it's a mean reversion strategy. I'll not hold you back further. Don't want to hold on to your lunch. Mean reversion strategy. Okay. Please make sure you understand this statement. If you don't, in the next class you ask me. Okay. All right. So your class is dismissed. Anybody has a question can stay back. Rest can leave.
Yes, sir. I have a question.
Yes.
Sachin this side, sir.
Yes. Yes. Go ahead.
Sir, I want to ask about the interactive broker.
Yeah,
Sir, can we start investing right now, or if we start investing right now, or we can earn profit. So it is calculated, or if we profit calculated after 15 September.
Correct, correct. You have to look at your date. The
Yes, sir.
project start date, I will look at your returns only after the project start date. So when you submit your results, you will be submitting the results
Yes,
for
sir.
that period only. So when you start 14 September Monday,
Sir, yes, sir. For example, if we earn profit right now, or if we earn profit right now, and after 15 on 15, if our profit is, for example, $1 million plus $5,000, for example.
yeah,
So our portfolio calculated 1.5, one dollar, 1.5 or only $1,000, $1 million.
no, no. See, what I will do is whatever you had here,
Yes, sir.
I will take the balance, starting balance for this day. Okay.
Okay, sir. Starting balance for this day.
Yeah. The closing
What
balance
balance?
this
What
day.
is the balance I have in my portfolio?
Whatever the balance,
Yes, sir.
that's why I told you to ensure that you don't lose too much money, because then you have too little balance to play with. So I'll take
Yes,
the
sir. Yes, sir.
balance here, and I'll
Yes,
take the
sir.
balance here. Then I will take the ending balance here.
Okay, sir.
Okay. So then your return will be calculated. Let's say your starting balance was, say, 5. I'm just giving example. Okay.
Yes, sir.
Then your ending balance was, say, 185. Then your return will be calculated as, say,
80.
basically
80, sir. Simply.
this divided by the general way we write the formula is this minus 1. Okay. So this is,
Percentage is when you refer to percentage. Yes, sir.
that means your when I calculate your raw score,
Yes, sir.
the numerator of the raw score will be this for you.
Yes, sir.
Okay, and the denominator will be whatever is your in between here to here. Okay, what is
Yes, sir.
the drawdown of your NLV plot? Okay, remember maximum drawdown? We have explained what maximum drawdown is.
Yes, sir. Yes, sir.
This is your NLV plot, then there's not much drawdown. But if you look at all, and then if your NLV plot, then every time it comes from a peak, goes down, this is your drawdown. Then this is another drawdown. So look at the maximum drawdown. In this case, the maximum drawdown is this one, not this one. So we will look at your day-to-day NLV plot and see which is the maximum drawdown. And that will be your denominator. This is your numerator,
Yes, yes.
and we will find out what your denominator is. So we need to know the returns. That's why I will need daily data from you. In your submission, I will need daily data on the NLV.
Okay, sir. Okay, sir.
Sir,
Any
sir, suppose we have less than 1 million, then the denominator will be 1 million or the amount which we have.
Starting amount. So if your figure is, let's say, 92, I will take your starting figure, okay, and I will take your ending figure.
Okay, sir. Okay.
So whatever it is, that's why I said don't reduce this figure too much, because then you can't actually buy much stock and all that. So I didn't want you guys to lose too much money in the practice period, right? So that you have enough firepower to buy as much as you want or sell as much as you want. So that's why I said don't try not to lose too much money in the trading, in the trial period. But whatever is your balance, okay, yours may be 92, Sachin may be 105. It doesn't matter. What matters is what you do in this period. Is this clear? Yes.
And sir, suppose
Yes.
I have purchased one share now and I will send it on 14th October. Then that will be counted or not?
It will be, because if you are holding it, see, it's being marked to market every day. So I will start with the closing figure of previous Friday actually. Okay, because the NLVs are closing, daily closing figures. So when I look at this, okay, or even in the statement for 14th, I'll see the starting NLV, which is basically the closing of Friday. This is Monday, the previous Friday.
Okay, okay. So, sir, you will calculate the price from 11 September, whatever the price.
Yeah. So that will get captured in the figure, which
The
is
share.
starting.
Okay, sir.
Whatever happens, it's always the starting NLV and it's the ending NLV divided by the starting NLV. And all your figure, remember NLV is basically what in general is referred to as NAV. So NLV, this is all there in the notes which are there in your if you see here in your calc file. I had a discussion with Mukul. So this is there in that discussion, NLV and NAV. Okay, it includes both what Vipul is referring to, that stock which he's holding, that will get captured in the unrealized P&L. So the NAV, NLV captures everything. You can't hide.
Yes, sir.
I'm not looking only at this, I'm looking at this also. Is
Okay,
this
sir. Sir, it's clear, sir.
okay? Anybody, anything else? All done? Okay, good. Enjoy your lunch. All right.